Just like that, a brutal correction. Bitcoin just crashed from its all time high, breaking below the critical $100,000 level and hitting a 6 month low, with some reports clocking the bottom between $94,000 and $96,000. Over leveraged traders were absolutely annihilated, with well over $1 billion in long positions completely wiped out in just 24 hours. The fear is back, and everyone is asking the same questions. Is this it? Is the bull run over? But what if this catastrophic market cleansing was the final shakeout before a massive coordinated wave of liquidity is scheduled to hit the system? The Federal Reserve has indicated it will stop its policy of quantitative tightening on December 1st, and that's just the beginning. In this video, we're going to cut through the noise. We'll break down the anatomy of this crash, reveal the series of powerful liquidity events set to begin on December 1st, and lay out a clear comeback plan so you can be positioned for what could ignite the next epic bull run for Bitcoin. So, what on earth just happened? This wasn't a random dip. It was a perfect storm of technical breakdowns and a brutal internal market cleansing. First, let's talk about the trigger. The market got extremely greedy. After soaring to a new all-time high of over $126,000 in October, traders piled into leveraged long positions, betting that the only way was up, but the market had other plans. As the price began to turn, it triggered a liquidation cascade. Think of it like a line of dominoes. The first margin call forces a trader to sell, which pushes the price down further. This triggers the next trader's margin call, forcing another sale, and so on. In just 24 hours, this death spiral wiped out over $1.1 billion in leveraged long positions. Data from CoinGlass showed that the vast majority of these were longs, showing just how dangerously one-sided the market had become. This internal collapse was amplified by macroeconomic pressure. Throughout November, market expectations for a December rate cut from the Federal Reserve completely collapsed, plummeting from a near certainty to a coin toss. This sent a shockwave across all risk assets, from the NASDAQ to crypto, as investors braced for a higher for longer interest rate environment. On top of that, long-term holders who had been sitting on massive unrealized gains began to take profit at record levels. Data from CryptoQuant showed that these holders sold off hundreds of thousands of Bitcoin in just 30 days, adding immense sell pressure right as institutional and ETF demand began to weaken. When you combine a massive internal leverage flush with fading institutional demand and a shaky macro backdrop, you get exactly what we saw: a violent correction that shook out the tourists and reset market sentiment from extreme greed back to extreme fear. But now we have to talk about the future, because while the crash was brutal, it may have been the necessary evil to set the stage for the next major leg up, and it all starts on December 1st. For the past several years, the Federal Reserve has been conducting what's known as quantitative tightening, or QT. It's a complicated term for a simple concept. The Fed has been systematically pulling money out of the financial system. Think of it as the tide going out, draining liquidity from the markets. This process has been a major headwind for risk assets like Bitcoin, but now that's set to change. The Federal Reserve has indicated that this policy of quantitative tightening will stop on December 1st. This is a huge deal. Why is it ending? The Fed's key indicator for this process, the reverse repo facility, or RRP, is approaching zero. This facility is where financial institutions park their excess cash. It peaked at over $2 trillion, but as the Fed has drained liquidity, that cash has been put to work elsewhere, and the facility is now nearly empty. The Fed knows that continuing QT beyond this point risks another September 2019 style liquidity crisis, where short-term lending markets freeze up, and they are committed to not letting that happen again. The end of QT means the Fed will stop actively sucking money out of the economy. This action alone, stopping the drain, is a neutral to bullish signal. It removes the primary headwind that has been suppressing asset prices. The tide is no longer going out. This allows liquidity levels to stabilize and eventually begin to rise again. While some analysts argue this isn't a direct injection of new money, they're missing the point. It's the critical first step. You can't fill a bucket that has a hole in it. By stopping QT, the Fed is finally plugging the hole. This sets the stage for the next phase, where new liquidity can actually begin to flow back into the system and push asset prices higher CTA. So what does this all mean for the future of Bitcoin? The end of QT on December 1st is the first domino to fall in a chain of massive liquidity events. It's the foundational shift that makes everything else possible. Now let's get into the reinforcements. But first, if you're getting value from this in-depth analysis, do me a huge favor and hit that subscribe button. And let me know in the comments below, do you think the end of QT is the bullish catalyst we've been waiting for? The end of quantitative tightening is the big one, but it's not happening in a vacuum. Several other powerful liquidity tailwinds are lining up for 2026, which could turn this recovery into a full-blown bull run. First is a proposal from President Trump for a tariff rebate. He has floated the idea of sending checks of around $2,000 to American families funded by revenue from tariffs. Now, to be perfectly clear, this is still a proposal and would require congressional approval to become law. However, Treasury Secretary Scott Bessent has confirmed it's being discussed for families earning under $100,000. Depending on the final details, budget experts estimate this could inject anywhere from $300 to $600 billion directly into the hands of consumers. We all saw what happened during the pandemic when stimulus checks hit bank accounts. Much of that cash found its way into the markets, and this could be a significant booster. Next, we have a more reliable seasonal liquidity event, tax refund season. Every year between February and April, billions of dollars flow back to households in the form of tax refunds. This injection of cash consistently provides a tailwind for consumer spending and investing, and early 2026 should be no different. This provides a predictable, seasonal boost right as the effects of QT ending are taking hold. Finally, there are longer-term tailwinds taking shape. We're seeing early-stage discussions in the financial industry about potentially exploring longer, 50-year mortgage terms. While this is highly speculative, a widespread move to longer-term refinancing would lower monthly payments for millions of homeowners, freeing up trapped capital and increasing disposable income, some of which would inevitably flow into alternative investments like Bitcoin. When you stack these events together, the confirmed end of QT, a potential multi-hundred billion dollar stimulus, and a predictable seasonal liquidity boost, you start to see a powerful narrative forming for 2026. So the market has been violently reset, and a tidal wave of liquidity is forming on the horizon. What's the actionable game plan? How do you position yourself for this comeback? This is not the time for panic selling. This is the time for strategic accumulation. The single most effective strategy in an environment like this is dollar cost averaging, or DCA. By investing a fixed amount of money on a regular schedule, whether it's weekly or monthly, you remove emotion from the equation. You buy more Bitcoin when the price is low and less when the price is high. It's a disciplined approach that allows you to build a position and lower your average cost basis ahead of the anticipated liquidity injections. The key is to own the asset before the narrative becomes obvious. By the time news breaks that a tariff rebate has passed or that the Fed is hinting at a new round of quantitative easing, the price will have already moved. The biggest gains are made by those who position themselves during moments of fear and uncertainty, not during moments of euphoria. Look at the timeline. The first major event, the end of QT, is happening around December 1st. This removes the immediate downward pressure. Following that, we have the potential for a stimulus debate and the certainty of tax refund season in the first quarter of 2026. This creates a window of opportunity right now to build a position while the market is still digesting the recent crash. This pullback, as painful as it was a gift. It flushed out the excessive leverage, shook out the weak hands, and offered a chance to buy Bitcoin at levels we haven't seen in 6 months. Now, with a clear liquidity timeline ahead, the path forward is becoming much clearer. So here's the bottom line. The brutal crash below $100,000 was a necessary and, in retrospect, healthy market reset. It was driven by a catastrophic cascade of liquidations that punished greed and prepared the market for a more sustainable foundation. Now, the macro environment is about to undergo a seismic shift. The end of quantitative tightening on December 1st is one of the most significant changes in monetary policy in years, stopping the relentless drain of liquidity from the system. This is potentially reinforced by a series of liquidity injections on the horizon, including a proposed tariff rebate and the annual tax refund season. The path forward will not be a straight line. There will be volatility. But for those who can see the bigger picture, the plan is clear. This isn't the time for fear, it's the time for strategy. By understanding why the market crashed and the powerful forces getting ready to propel it forward, you can position yourself to ride the next great wave, stay disciplined, think long term, and don't get shaken out. The stage is being set.